Greetings, everybody. I'm back. Woo! Welcome back to Strongman Personal Finance. We got a sponsored video. That's right. Somebody paid me big money, $100,000, to do an analysis of this stock. And that's what I'm going to do. What stock is it? Well, you've already seen the title of the video. It's Prologis. It's a real estate investment trust. What is a real estate investment trust? Basically, you're buying a portfolio of real estate. There's some real estate investment trusts that invest in mortgages, which I don't like those. But in general, a real estate investment trust is a real estate portfolio that is publicly traded. You can go on Robin Stock, or you can go on Charles Schwab or Vanguard or whatever freaking brokerage you use. And you could buy a real estate portfolio that trades just like a stock, and it's required to pay basically all of its income out as dividends. So if you want to invest in real estate and you want passive income, look no further than Prologis stock. So what is this all about? What are we going to do? Is this stock going to 10x? Well, Prologis is a absolute mother effing beast. I didn't know a diddly squat dang dong thing about this stock, but I recognized the name. Why did I recognize the name? I'll show you in a second. So here's Prologis, okay? Its stunk price is $114. Oh, it's expensive. It's down 5% today, so it's trash. $105 billion market cap. This is a big company, okay? $105 billion market cap is a very, very massive company. Now, if we look at the historic stock price appreciation, this is a REIT that pays dividends, which are taxable to ordinary income rates, but the stock is still up 70-something% in the past 5 years. That's pretty freaking good. I think that's beating the S&P 500 as a matter of fact, which is pretty incredible because the stock's up 70% and the dividend yield is 3.04%. Pretty impressive. Now, we look at the market cap to revenue. That's pretty crazy, okay? That's trading at a pretty high multiple of revenue. It's got net income, which means it's profitable. Now, I want to put one thing out there. So I looked at another real estate investment trust, and everybody got mad because I looked at the income statement. Oh my God, I looked at the income statement. And then I looked at the statement of cash flows, and they said, you need to look at funds from operation. That's how Wall Street analyzes real estate investment trusts and rental properties. What do you think a statement of cash flows is? Okay, what do you think happens on a statement of cash flows? We'll get there in a second. But all you clowns, it's funds from operations. It's how you judge real estate. I can judge real estate however I freaking want to, you freaking clowns. Anyway, let's continue. So what's this company all about? It is a global leader in logistics with a focus on high barrier, high growth markets. The company owned or had investments in, on a wholly owned basis, ventures, properties development projects, expected to total 1.2 billion square feet. Now, their specialty is leasing logistics facilities, okay? Logistics, a warehouse, Walmart, Amazon, they all these freaking warehouses, okay? Basically, Prologis owns those and they rent them out to massive corporations. So you're not looking at a clownish portfolio, okay? You're not looking at a real estate investment trust that invests in, subprime mortgages. This is a freaking giant that leases to some of the most recognizable companies in the world, okay? Now, if you want to look at their portfolio, here's a better snapshot of what they have. So they have 1.2 billion square feet of square footage in their warehouses. I don't have any context of that, but I guess that's a lot, okay? 1.2 billion square feet. More than half is in the United States with 3,800 buildings. They have 320 buildings in Brazil. They have some in Europa. Looks like, 20% of the portfolio. And then they have, oh my God, they have real estate in China. Oh my God. Oh! But overall, this is a massive freaking company, okay? Now, they divide their company into a couple segments. So they have the real estate segment, which is their rental operations. They develop real estate, they build. And then they have the strategic capital segment. Now, we can see the net operating income. This is how they measure operating. Oh, this is operating income before taxes and interest or something like that. That you can see that their operating income has increased pretty significantly over time. A big reason this jump is here is because they acquired, with an all-stock transaction, a company called Duke. So they made a big acquisition, which is why they have a huge jump in net operating income from rental operations. Real estate development, obviously, they're spending a lot of development, okay? And then you see strategic capital segment. So with this segment, basically, they enter into joint ventures with other real estate developers. And, they provide management services, stuff like that. And you see these massive fluctuations in net operating income for their strategic capital segment. This is because they get like incentive bonuses. Like if they meet certain metrics in the venture, they get these huge bonuses. So you're going to see these like huge swings in net operating income from strategic capital segment. But it'll be like, oh, bro, look at that vertical line. I mean, that obviously you can see there's bonuses that get paid out. That's exactly what's happening there. But overall, this is a beast of a company. So let's talk a little bit more about the taxation. So taxation is important, okay? Taxation will massively reduce your total returns as an investor. You want to mitigate taxes as much as possible. With the real estate investment trust, it's basically required to pay out most of its profits in dividends. That's one of the requirements to be structured as a REIT. And when they pay out those dividends, those are called ordinary dividends. Now, there's dividends that are taxed at lower rates called qualified dividends, and then there's ordinary dividends. The ordinary dividends are taxed at your marginal rate. So if you're in the 20 whatever percent tax bracket, that's what you're going to be taxed at. It's going to increase your income. So if you're in the highest tax bracket, 37%, I think, you're taxed on that income at 37%. Now, this does qualify, well, consult your tax advisor, but generally when I've seen REITs that have Section 199A dividends, this qualifies for a special deduction called the qualified business income deduction. Obviously, it really depends on what you're invested in and how long you've been invested in it. But I've seen a lot of REITs, and it looks like this one is, generally qualify for Section 199A QBI deduction, which is a additional 20% deduction on certain types of income. The point I'm trying to make here, you're still being taxed pretty heavily on this company, okay, on the dividends that are distributed to you, because the corporation is not taxed. The REIT is not taxed. You as the investor are the one paying all the taxes. So you might want to consider maybe putting a real estate investment trust, kind of like bonds, which also play interest, which is taxable at your ordinary rates. You might want to put those into a tax advantage account if you want to invest in a real estate investment trust, because you're going to pay higher taxes than normal. With qualified dividends, like ordinary dividend, like not ordinary, but companies that are, not real estate investment trusts. If your dividends qualify for qualified dividends, depending on your income, you could not pay any tax at all, even in a taxable account. That's right, based on your income. So be very careful with REITs. You can have all these REIT investments and all these dividends. You're paying a lot of taxes, okay? So consider a tax advantage account. Now, another thing I want to mention is the reason I recognize this company is because I remember I bought V&Q. I was like, I'm going to do factor tilting. I'm gonna have some small cap value, and I'm gonna have some some real estate, and the rest is gonna be VT. It's stupid. Don't ever do that. But Prologis, whatever you want to call it, is the largest holding in the Vanguard real estate ETF. So my question is, it's like, okay, if you buy if you buy a real estate ETF, you're getting pretty decent exposure to Prologis without actually going all in. But not the worst stock in the world, okay? I mean, at least they make money. If you want to do like a small speculative play, you can do whatever you want. You can buy Tesla. You can buy Bitcoin. You can trade options like a clown. As long as you keep it to a small part of your portfolio, I don't got any problem with it, okay? But just so you know, Prologis is the largest holding besides another REIT inside the Vanguard real estate ETF. Okay. So let's look more at the financial statement. So we know they lease to logistics. They're all about logistics. They have tons of warehouses across the world, mostly America, Brazil, Europe, China, Japan, stuff like that. We know they pay dividends that are taxed at higher rates, but do generally qualify, depending on your situation, for qualified business income deduction on your tax return. Consult your tax advisor. Let's look at the company's growth. So we can see that the revenue is generally trending up, probably mostly due to acquisitions. One good thing about a lot of REITs, depending on the REIT, is you could have, they generally can raise their rents with inflation. So in the long run, rental income will increase with inflation because everybody knows that rent goes up. We all know that rent goes up. Okay. Let me pause to make sure y'all can hear me. Okay, good. We all know rents go up with inflation. Okay. So we know their income, their revenue is going to go up. Oh my God, why are you looking at the income statement? It makes no sense. Shut up. I can do whatever I want. Okay. Obviously, high gross margins, high operating margins, very high profit margins, which is kind of crazy because you think about real estate, right? Real estate has a lot of depreciation. What is depreciation? It's expensing the cost of a capital asset over its useful life. REITs generally have a lot of fixed assets because they own real estate, and you have to expense those. And it's a real expense because you're recording the cost of the real estate that you purchased. That's right, over its useful life. But even then, they have pretty high profit margins. Free cash flow margin, obviously, it's negative. Why? Because they're doing a lot of investing. They're buying other properties. They're developing other properties. That's why they have negative free cash flow. Let's go ahead and look at the shares outstanding. So we can see shares are going up. Why are shares going up? Well, most recently, it's because of the Duke acquisition. They bought Duke, which had like 2 million square feet of real estate, or 200 million square feet of real estate. So they massively expanded their portfolio by a pretty significant amount by acquiring Duke, which I think is mostly based in America. But they basically issued a bunch of shares. They just bought it with shares, which is pretty crazy. So you see their share count has gone up massively. That's basically why. We'll look at the balance sheet on the actual financial statement. So operating cash flow. So let's talk about funds from operation. So I looked up this real estate term. It's called funds from operation. And basically what they do is they take the net income of real estate, they add back depreciation, they add back amortization. Oh, so does the statement of cash flows, the operating section. And then they add back like interest and taxes. Basically, operating cash flow is pretty similar to funds from operations. Okay, you freaking clowns. It's basically the same thing. Okay, when I look at cash flow, I think interest matters. Okay, I think taxes matter. I think the holistic understanding of the company matters. Oh, just ignore depreciation. Just ignore amortization. Don't worry about interest. Don't worry about taxes. Because what companies, yeah, I mean, it doesn't matter if they're paying $1 trillion in interest. It doesn't matter, bro. Just funds from operations, just add it back. You should look at everything holistically, okay? I like to look at the operating cash flow. We can see that they've had massive increases in operating cash flow, okay? But the metric people like to use is funds from operations. So shut up. I don't care. All right, capital expenditures. We see they're spending a lot of money in development, buying other businesses. We see acquisitions here. Let's see, dividends. Now, here's the impressive thing. They've been steadily raising their dividend. Like, this is a dividend, what do they freaking call it? Dividend compounder. Basically, they've been growing their dividends pretty steadily. And you can see they're able to grow their dividends because their cash flows, their operating cash flow is massively increasing. Now, how do they do most of their acquisitions? Well, we know they issued a bunch of shares for Duke. And we can see, oh, look at this. How are they raising money? They are more debt-focused than share-focused, okay? Now, the reason you see zeros here on share issuance, even though they used shares to buy Duke, is because they just issued shares. There was no cash flow. Okay, it was basically almost a non-cash transaction. But they do issue shares to do acquisitions. But a lot of their financing comes from debt. Now, when I looked at their debt portfolio, their debt holdings, they had pretty low interest rates on their debt. Let's see, here it is. I was pretty impressed with their debt. So they have credit facilities, this is like short-term borrowings, 5.4%, senior notes, 2.9%, with a weighted average, a weighted average term of 10 years, term loans, secured mortgages. They have very low interest rates on their debt. I got no problems with that, okay? This company is doing I don't think they're going to go bankrupt anytime soon, okay? Doesn't mean the stock can't go down, because it can very easily. I don't think they're going to go bankrupt anytime soon, okay? Very low interest rates on their debt. Let's go ahead and look at their balance sheet. Let's see. Consolidated balance sheets. Okay. Let's see. So June 30th, 2023. So this is a couple months ago. Okay. Investments in real estate properties, 86 billion. That's a lot. Less accumulated depreciation, just under $10 billion. Basically, what that means is a lot of their properties, they're not super old properties. If they developed these properties and they started using them, they're not very old. Now, when you account for purchasing real estate, basically you record the total transaction price as a fixed asset, and then you depreciate it or expense it over its useful life. So you can see if a company has a lot of real estate, but their accumulated depreciation is also very high, that means they have a lot of old properties. This, at least on the surface, looks pretty good. Okay. They don't have a ton of depreciation. So their properties, don't quote me here, seem to be newer. Now, if they had bought older properties, that's a different story. But overall, you look at their balance sheet, they don't seem to have old properties. Okay. Investments and advances to unconsolidated entities. So this is basically investments in entities that they don't have control over. Okay. Because when you control another company, you consolidate it on your balance sheet. You just combine the companies together. That's why it's called the consolidated balance sheets. These are just investments where they don't completely control. This is probably where they get their strategic capital. That's where they get all their big bonuses from. Assets held for sale. They're not really selling a lot of stuff. So overall, their net investment in real estate is $87 million. Now, or $87 billion. So if you look at their debt, they have total liabilities of $34 billion on net investments of real estate of $87 billion. That's not bad. Okay. Their balance sheet doesn't look that bad. Okay. Let's see. Yeah, this is a good balance sheet. Like I don't really have any bad things to say about the balance sheet. Okay. I mean, overall, like this is a beast. This is a freaking beast. Okay. They're growing their revenues, mostly looks like through acquisitions, especially with Duke. They get these massive bonuses with strategic capital. That's going to fluctuate. But they've more than doubled their revenues, it looks like, or they've almost doubled their revenues year over year. A big contributor is strategic capital, but a big part of it was also the acquisition of Duke. Okay. Highly profitable business, strong growing cash flows, growing dividends, great balance sheet, very diversified portfolio. I mean, I don't see like anything horrible. I mean, just from a business standpoint, I don't see any issues. Now, that doesn't mean that you're going to make a lot of money on the stunk, okay? Because, you could have the most beautiful balance sheet and the most beautiful income statement in the world. The market kind of knows that. They kind of know. People also know how to, well, ideally, they know how to look at financial statements, okay? So, you're not going to necessarily make money just because they have good financial statements. But overall, like, I don't see massive red flags with the actual fundamentals of the business. But when it comes to stock price, I can't necessarily tell you what's going to happen with that. If you want to have a small speculative play, I got no problems with it. Just know that you're going to pay a lot of taxes if you hold it in a taxable account. There's other options out there if you want to get exposure to real estate. This is the top holding in the VNQ ETF, but it's not the only holding, so it's more diversification. That's kind of my thoughts. I mean, I guess let's see if there's any comments, see if there's any questions about my investments, my stunk analysis. Hey, strong man, you're looking sexy today. I always look sexy. You look even better if you lost 50 pounds. You should say that to your girlfriend, see what she says. Strong man, what happens to VT when the dollar inevitably collapses under its own weight? I have no idea. I don't know. Maybe the dollar will be replaced by crypto, and then my VT will be denominated in shark coins, and then it'll 10x. I don't understand how our dividends are concerned with Shida going down. They should be happy. And the constant O shills are so... It's hilarious. I don't know what to say. Shida, bro! See, it's got dividends, and the stock goes up. So you can live off the dividends. But the stock, or the ETF also goes up too. You can't lose. I think VT's been clapping Shada recently. It's pretty funny. Pretty funny. Bonds and CDs are paying about 5% interest now, so people are not much hyped about dividend investing. So that's another thing. Okay. Right now, you can lock in, what, a 10-year treasury. What is a 10-year treasury yield? Treasuries, bro, stocks. Treasury yield, 10-year. Let's see. What's a yield, bro? Okay, so you can buy a 10-year treasury right now. You can lock this in at 4.5%. And it's the federal government. Okay, you're going to get, I mean, nothing's guaranteed, but you're going to get your interest payment. This is probably why REITs are maybe selling off. I don't know exactly why they're selling off. I've noticed a lot of REITs have sold off recently. This may be part of the reason. You can get a 10 years, you can lock that in. Okay, that's pretty impressive. I wonder what the 30-year is at. 30 years, bro. What about the 1,000-year treasury? I wonder what that's yielding. Wow. Well, if this is accurate, let's see. Yeah, you can lock in a 30-year. Look at that. Rates are crazy, man. I mean, that's why, like, if you want income, if you're an old retired person, you're like, should I buy a real estate investment trust? Or should I buy a 30-year treasury and lock in 4.5%? I don't know. It's more, there's more calculus there. Okay. This is a lot different than before when treasuries were like, what, 1%? They were garbage. Now they're more enticing. Okay. There's also risk to long-term treasuries. So they're risk-free, bro. They're not risk-free. But that could be a reason why real estate is, not necessarily as attractive on a comparative basis. But hey, doesn't mean you can't lose money. You can make money, bro. All my money is going to a savings account and IRA. Good for you. It's just a gimmick, though. You get 5% interest and your money loses 5% of its value. Yeah, that's true. But I mean, if you think about it, if you lock in a treasury, a 30-year treasury right now at 4.5, and then inflation goes down to 2%, which I think that's what the Federal Reserve wants. They want inflation at 2%. You might actually come out on top there, but I'd rather buy stocks. I'm 34. What kind of dividends are in V&Q? It's got to be the same, because real estate dividends, REIT dividends are ordinary dividends. They don't have that special tax treatment because the entity of a REIT is not taxed. The tax flows through to the individual investor. So if you're in a low tax bracket, okay, maybe it's not a big deal. Like I'm in a low tax bracket. Okay, I got a big standard deduction and I'm the only person that works in my family. So I wouldn't pay a lot, but I would prefer to put it in a tax advantage account. Let's see. Isidro Arias. Hey, strong man. After losing 20K in gambling. Woo! Gambling in what? I think I'm switching to VT after watching your videos for almost a year. Thanks for being the light in the dark world of YouTube grifters. Well, you just lost $20 more. No, but in all seriousness, thank you very much. I appreciate the donation. And look, buying VT, it's like, I got no worries in the world, man. I started my 401k at my work a couple months ago, and there's already like $4,500 in there. I just put as much money as I can. I max it out. I buy the total world index, or I try to approximate it, and I just go to work. When I was in the Army, man, I would just drink and go out and drink more. It's all I did was drink and party. And guess what? I was growing my wealth, buying a total market index. I didn't have to think about investing. Okay, it's that easy. You got to be dedicated. You got to stay the course. Okay, if you want to gamble on clown stocks, a couple percentage points of your portfolio, whatever. But the vast majority should be in a tax advantage account in a total market index, America or world, whatever. and you'll probably be better off, in my personal opinion. But thank you very much, good sir. I appreciate the donation. I'm going to probably put that in VT, I'll be honest. Let's see. After I pay my taxes, of course. You will be selling blood to eat bugs after the New World Order. What? Yeah, I'm sure. 3% dividend isn't enough for me. I want at least 20% dividend so I can pay more taxes. Yeah, I like taxes are awesome, bro. Let's see. AT&T and Disney are looking good. Sure. Walgreens looking good. Sure. Yeah, the dividend yield, bro. Mo looking good. When stock's going down a bunch, clowns keep telling people you can't buy this, you can't buy everything. Here's the thing, bro, okay? Sometimes stocks go down for a good reason. Keep that in mind. That's what value, like, see, that's why, like, I kind of laugh at value investors because growth investors, they just buy stocks that go up, basically. Value investors, they like to buy stocks that go down. And it's like, well, stocks can go up for good or bad reasons, and stocks can go down for good or bad reasons. Why don't you just buy them all? Okay, maybe that's an idea. Because stocks that go up can keep going up maybe it's for a good reason. Stocks that go down can keep going down. Let's see. You like Jeremy's little Wynn resort? Oh, does he have a Wynn Resorts hat now? You know why he invested in Wynn? It's because it's in Vegas. There's a Wynn in Vegas. Am I crazy? Wynn Vegas. Yeah, there's a Wynn in Vegas. Yeah, the reason he invested, I swear to God, the reason he invested in Wynn was because it's in Vegas. That's how stupid he is. It's the same thing with Planet 13. Why did he invest in Planet 13? It's in Vegas. That's his logic. He's so stupid. Smart people buy VT. Dumb people buy VT. Well, I'd say if you buy VT, you're a genius, but, whatever. I think for some people, it's almost a sport to try to beat the market, pick stocks. They don't want to acknowledge the odds. Like, yeah, let's just have fun with it, Most of it in index funds, okay? You can also making videos to stupid people to make money. Well, I think my audience is a little bit more intelligent than the average Joe on YouTube. That's my personal opinion. Maybe some people hate watch me, but overall, I think people that understand like index investing are probably smarter than the average moron that watches YouTube. Okay. All right. Well, that's Prologis. I mean, it's a beast. It's an absolute beast. I like the company. Like, it's a giant. Highly profitable, expanding, growing their dividend, great balance sheet. I mean, there's nothing to hate about it. It's just, that's the thing with stocks. It's just because the balance sheet's good doesn't mean the stock's going to go up. So look at PAGS, which is in Brazil with no debt. Well, if you give me $50, I'll look at the financial statements, but all right, guys, we'll do a LaFufu outro. Thank you for attending. I haven't made a video in a couple days because I just didn't feel like it. And talk to you later. Cheers.
Bye, 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 bye. I know I'm a grifter, strong man. You could lick your hand and smack me in the nutsack. Thank God for Tesla, my Esla, and you, strong man.